Good afternoon, everyone, and thank you for joining us for this final session of the day. We've had an amazing afternoon, but we are running slightly behind, so apologies. We're running about 30 minutes behind, but I promise this is going to be a very lively, very engaging session, and drinks are very close nearby afterwards. So just to introduce myself, I'm Tamsin Ballard from PRI. I'm the Chief Initiatives Officer, and delighted to introduce a fantastic panel of industry leaders. We have Jake Barnett, Managing Director from Wespath, Anne Simpson, Global Head of Sustainability at Franklin Templeton, Mirza Baig, Chief Sustainable Investing Officer at Aviva Investors, and Nazmeera Moola, Chief Sustainability Officer at 91. Now, I'm just going to say a few words of framing for this discussion before we turn to our speakers. So as you know, this is focused around what can net zero investors, what should they be focusing on in order to keep 1.5 degrees alive? So first thing, why the 1.5? Now, I'm sure many of you in the room shudder when you hear that phrase, keep 1.5 alive. Why? Because we're already at 1.2 degrees. And scientists are telling us we are hurtling towards the 1.5, far, far faster than we should be. So we really need to be moving exceptionally fast on the net zero transition, because every fraction of a degree of global temperature rise increases the risks that we're going to be passing dangerous and potentially irreversible tipping points to our global climate and nature systems. And that means major threats to our economies, and to your portfolios and to your returns. Secondly, the role of investors. So the aim for investors as fiduciaries is around enhancing and protecting overall returns. And that requires understanding and addressing major current and emerging risks and opportunities. Now, system-level risk with climate change absolutely ticks those boxes. So there's a role for investors here in terms of how they can contribute to the decarbonisation of the economy in order to manage those risks and harness those opportunities. And then finally, stewardship. The role of investors using their influence, using their voice with their investees, with policymakers, with stakeholders, to be thinking about these risks, addressing these risks, driving that decarbonisation and that net zero transition. And we've heard a lot about this, the power of the investor voice over sessions yesterday and today. And that's the focus of our discussion today. So on that, let's move on to the discussion. Now, it's the final session of the day, so I imagine there's quite a lot of panel fatigue at this stage, so we thought we'd try this in a different format. So huge thank you to all of our speakers for being brave and taking this on as a debate. So, question. In order to be most effective in addressing system-level climate risks, investors should refocus their stewardship efforts on engaging with policymakers and sovereign issuers over corporate engagement. So we have two teams for this debate. Jake and Mirza are going to be arguing the case for this, so saying, yes, we need to pivot to policy engagement. Well, Anne and Nazmeera are going to say, no, let's stick to what we know here. We need to be focusing on the corporate engagement. So we're going to be hearing from both of them, both of the two teams, and let's see where we get to. But just before we start this, we're really interested to know your views on this. So if you could all please open up Slido, and what's your thoughts? Which camp would you be? Which team will you be on this? Is it policy engagement or is it corporate engagement? And we'll come back and have a look at those results shortly. But maybe if we can start off, Jake, if I can invite you up to argue the first case for policy engagement.
I'm going to make the case for policy engagement with 4 core arguments: how it aligns with long-term interests of investors, especially asset owners, the public policy power mismatch, how investors can engage in policy, and why we as investors need to do this. Let's start with how it aligns. We've heard from many investors throughout this conference about systemic risks and how we need to look at broadly diversifiable portfolios and long-term interests when we're thinking about allocating our assets and our stewardship resources. I've argued this in my role as the co-lead of the Net Zero Asset Owner Alliance engagement track, where with my fellow co-lead Patrick Para, we wrote a paper called The Future of Investor Engagement. That paper argues that systemic risks need to be engaged by investors using systemic tools. The reason for this is simple. We're not just facing a problem where you can move individual corporations along the playing field as it exists today to achieve net zero. You need to move the playing field as a whole. The bounds of regulatory and policy environment do not allow for corporations being profitable in the current market environment. And so you need to think systemically about how are you investing in your stewardship resources to help align with your systemic long-term interests. When we look at the power of where corporations are investing resources and where investors are, there's a mismatch. In the US context, there was a study from the Journal of Law and Politics which found that for every dollar invested in lobbying, $200 of return were achieved. The Harvard Business Review found this motivation particularly strong in rent-seeking sectors that were taking advantage of government regulation. The article went on to say, the concentration of political influence among a narrow group of firms means those firms may skew policy for the entire economy. Of those 5 sectors that they named, 3 are in hard-to-abate sectors. Of those 3 sectors, oil and gas, utilities, and transportation, in 2023, they collectively spent over $500 million in lobbying in the US. I could not find a number for how much investors spent advocating for systemic risks, because I think it's so small that nobody bothered to study it. So if we agree that systemic interests and representing them are necessary, if we agree there's a problem in current lobbying dynamics, how do we address it? We engage directly as investors. You've heard great stories from the Sustainable Finance Action Council about how to do that. You can engage with corporations. There's the Global Standard on Responsible Climate Lobbying. There's the Climate Action 100+, which focuses on this issue. And if you're an asset owner, you can and should engage with your asset managers to make sure that they are representing your long-term interests. Finally, let's move on to the why. We've heard about how policy enables flows from Wendy Cromwell. We've heard from folks like Peter van der Werf about the power of sovereign engagement. We also know that you're probably committed to this if you're committed to net zero. The Net Zero Asset Manager Initiative has commitment number 9 as aligning your lobbying practices with your commitment to Paris. But I'd like to put on my spiritual, faith-based investor hat to end. I know this is hard. I know doing something new, especially when we're talking about this unprecedented transformation of the economy, carries risk. It might carry risk for you personally within your firm to do something new. But there's a phrase I've heard from many Catholic women religious, which is, courage is fear that said its prayers. So it's time to do the scary thing because it's the right thing. It's time to do policy engagement.
Thank you very much, Ruth. Anne, over to you.
Over to me.
It's going to be decimated.
I don't know whether to stand up on one leg on this little platform or dangle. Anyway, I'd like to speak to this point from completely the opposite point of view. And I want to speak to my friend Jake, working for Methodists. I'm going to speak as a lapsed Catholic. And something the Vatican does beautifully whenever anyone is coming forward for sainthood is to have someone to represent the devil. And the devil's advocate today is me. So I want to remind you of who we're talking about with policymakers. There's 3 problems. Number 1, policymakers are slow. Number 2, policymakers are confused. Number 3, policymakers are conflicted. Let me tell you why. They're slow. Why are we talking about COP29? It took 28 meetings to get to the point of heaven forbid, mentioning fossil fuels. Likewise, read the Financial Times' excellent editorial bemoaning the fact that we have megawatts on the sidelines waiting for permits to get connected to the grid. So slow is not our friend. The private sector moves quickly. Second thing, confused. So we have the lovely words, it took 29 years to get them, but here we are, moving slowly through many meetings, much stapling of documents, late night coffees. We've got some language, marvelous. We don't have the action, but the confused part comes here. I was just looking up the numbers from the IMF before we got on stage. Direct and indirect subsidies to fossil fuels are running at $7 trillion, twice what policymakers are spending worldwide on education. And of course, it will be no surprise to anyone that health problems related to air pollution take, tragically, over 1 million lives a year. Those subsidies represent 2/3 of the world's healthcare budget. So confusion is rife. Conflicted. Look at the emissions which are coming from state-owned enterprises. Most of the world's oil, gas, and fossil fuels is in state ownership. Policymakers again. So sainthood must be on hold, Jake. I'm sorry. We cannot refocus efforts when, guess where we are in this world? It's capitalism, baby. And guess where the capital comes from? It comes from the hard-working, ordinary people all around the world putting their savings into pension funds. That means we, in the investment management or the asset owner business, have a fiduciary duty. Prudence, loyalty, and care. Prudence, loyalty, and care do not permit you to be slow or confused or conflicted. Your sole duty is to the beneficiaries, and those have long-term interests. So we're at a position now where engagement is actually delivering practical results here and now. And of course, our example has to be good old Climate Action 100+. And I remember going to have tea with Mark Carney at the Bank of England when we'd looked at these 10,000 companies' emissions and found, gosh, about 100 companies represent 85% of portfolio emissions. And by having a data-driven approach, clarity, simplicity, practical goals, we now have that cohort at 97% of them with net zero targets. Now, a target then has to be acted on, which is phase 2, and we can talk about that. But the point is getting what is now, and these are Bloomberg New Energy Finance numbers, 25% of the world's greenhouse gas emissions are captured as a result of that engagement progress. Now, it's not perfect, and we've got more to do, but that is showing us how we exercise our fiduciary duty to ensure the repeatability of risk-adjusted returns with loyalty, prudence, and care. And we can't, under that role, under that duty, sit on the sidelines and just write reports and staple them and drink coffee and hope for the best. So if we move away from engagement, it will be a dereliction of duty, of fiduciary duty. And furthermore, that engagement with the big listed companies is creating the demand that folks have talked about, the demand for the hard-to-abate sectors. For that, we need new capital allocation as well, which is why engagement is the sister to capital allocation and transition finance. Engagement isn't the full picture for investors, but without investors, without mobilizing our common wealth for the common good, government alone will not be able to get us there. Imagine the financial system being run in the same way as the place that tries to generate even a driving license, a kind of DMV government model. It's not going to work. On carbon pricing, we need to sort out subsidies. We're making progress on reporting, but gosh, it's taken too long. So with that, beatification has to wait for policymakers, and meanwhile, investors, stick to your fiduciary duty, keep going, do not be deterred, and when you are getting pushback, guess what? People are paying attention to what you're doing because you're being effective. Thank you.
Mirza.
I'll bring your book.
Thank you.
I'll bring your book.
Sorry. I know. And this I got from kicking the can down the road, right? Thank you, my friend.
Right, good evening, everyone. So look, it's been coming up to 20 years since Lord Stern first started to socialize the notion that climate change represents the greatest market failure in economic human history. Now, fast forward to today, we've made some progress. There's more than 75 different carbon pricing initiatives out there. But the problem is that the average price of $32 per ton is wholly inadequate. And when we combine that with the fact that more than 75% of emissions are still completely free, then it's no surprise that in general, a company's emissions profile has little bearing on its financial performance, on its share price, or its cost of capital. So from a purely microeconomic perspective, companies are acting rationally by demoting the importance of emissions in key business decisions. Now, as investors, this is a wholly unacceptable outcome. So as a result of that, there's more than 60 trillion of assets that have signed up to take action. But what is the nature of that action? And my argument today is that we've got that wrong, primarily because we did not reflect on the theory of change for the specific problem at hand. Rather, we resorted to what we know, what we feel comfortable with, and that's corporate engagement. But given what we said about engagement being a market failure, talking to management is effectively, and engaging with them on this topic, is asking them to take irrational action by giving up financial performance for the sake of a public good. Now, I could talk for hours about what that would mean for different industries and different companies. Fortunately for you, the PI has only given me, I thought it was 5 minutes, but the clock seems to be going a bit quicker. I'll just, look, one simple example. Take one of the world's largest steel companies. They mapped out what a net zero plan would look like for them. And they estimate that it would double their capex spend over the next 10 years, while adding more than $250 per ton to their production costs. While on the other side of the equation, they're not seeing any premium pricing coming through on the demand side. Now, those of you that are familiar with steel company balance sheets and the wafer-thin margins that they operate under, this is more of an insolvency plan than a transition plan, and hardly a inspiring set of engagement asks. So I hope my point is clear. Engaging with management to effectively break their own business model based on a world that we want rather than a world that we actually see has not worked and will never work. Now, I know that people will point to various successes on corporate engagement. Look at the targets, look at the disclosures we now have. But I would argue that the only thing that counts is capex spend, because that allows you to cut through the noise and really see how a business is being positioned for the future. And on that metric, according to the TPI, 1,000 companies in scope of their recent report, only 1% of companies have aligned capex with their decarbonization goals. Disappointing, but not surprising. Now for the upbeat bit at the end. It doesn't mean we sit on our hands. We go back to the root problem. If climate change is a market failure, the problems are the rules of the game. And therefore, by definition, the ones that can fix it are the rule setters. You know, we've heard a lot about EVs over the last couple of days. That didn't happen by accident. It was a clear policy agenda. It was mandatory production targets. It was financial penalties, tax breaks, and consumer subsidies. And as a result, we now sell more EVs every single week than we did in 2013, just a decade ago. Now, we've just heard from the Deputy Prime Minister about all of the government programs that are in place. We've heard about the IRA, we've heard about the EU Green Deal. These have been critical and fundamental to decarbonizing assets, scaling critical technology, and crowding in private assets. when the policy is in place, corporate behavior changes automatically and rapidly. So as investors, if we want to keep 1.5 degrees alive, then we have no choice but to repoint all of our engagement to the real change makers, governments and regulators, and then let the animal spirit of public markets take over. Thank you very much.
Good afternoon, everyone. I understand we're the last thing standing between you and drinks, so let's try and keep the debate focused. I'm an economist by training, so I have a lot of sympathy for the argument that Jake and Mirza have put forward. We have market failings that need to be addressed. Companies respond to policymakers, and they respond to regulations. I'm not disagreeing. I think this is entirely true. What I'm questioning deeply is the ability of investors to change government policy. Investors had very little to do with government policy around electric vehicles or renewable energy. The average investor specializes in relationships with the Treasury Department and the central bank. We do not have deep relationships through departments of trade and industry, energy, electricity, mining. We have occasional interactions. Companies, on the other hand, have entire departments dedicated to this. This is what they do well. We have good relationships with companies. And I think the fundamental question is if we believe that long-term value creation is aligned with companies getting serious about the transition, we are best placed to hold companies accountable for their transition plans and the implementation around it, and for then lobbying government as needed. We're starting to see the tools being developed. Influence Map is starting to provide usable data in terms of what companies lobbying are doing. We need to hold companies accountable for that, because we have seen investors change company behavior. We look at the disclosure data, yes, we can write it off, but it's not something companies wanted to do very long ago. CDP shows us that disclosure is up 24%. The number of companies reporting is up 24% since the previous year. The number of companies formulating plans, which will then get to the CapEx, has doubled since 2022. 2 years, it's doubled. Most interestingly, companies in India, where the government target is 2070 for net zero, has seen a 514% rise in SBTi commitments over the course of the last year. So companies respond to signals from investors. And we can hold companies accountable because we have the tools to do that. So let's start with what's in our toolkit at this point, rather than spending a decade building a sovereign engagement business that we somehow are going to get asset managers to pay us to do. Thank you.
Great. Well, look, first of all, thank you, all of you, for an incredibly engaging, passionate debate there. So the question is, who won? Well, you may notice that we don't have a voting panel up here, so that's actually down to you. So again, if you don't mind opening up Slido and make a decision. Was it Jake and Mirza on policy, or was it Anne and Nazmeera on corporate?
And we noticed it was a girls versus boys team here.
Not deliberate.
You're going to have to stay neutral.
I will. And red team and blue-grey team.
Arsenal.
Great. So look, let's have a look. Okay, so 63% moving around slightly. So we've got around 2/3, oh, I was going to say about 2/3, getting closer between the two. Now, if we can also now, I don't know if this is still going, but if we can now just have a look at the results from earlier, because on this, I think it's quite clear that Nazmeera and Anne have this. Can we see the results from the earlier panel? Ah, interesting. Okay, so there's a big push earlier from the sovereigns and the policymakers, but there's a strong turn back onto the corporates and engaging with companies. Interestingly, we had a live session earlier and we put the same poll to digital attendees, and they came out with about the same in terms of saying about 2/3 on the corporate and a third on policy engagement. I think what would be really interesting is if we had a look at results, if we were to run this a year ago, would we be anywhere close to kind of 30–40% on policy? Because I've certainly seen over the past year a huge uptick in terms of kind of the interest and recognition of the enabling environment and the role of investors there. And again, interesting to look at this in a year's time to see how that may have changed. But I think for this debate, it does go to the corporate side. So thank you to Anne and Nazmeera.
Thank you.
But look, we just want to use the last kind of 10 minutes or so just to put a few questions to our panel of speakers, and also just to give them the opportunity for a balanced discussion, because I think everyone sees that there is potentially a role for both here, but I'm very grateful that they're willing to take kind of two opposing sides so we could have a really rich discussion there. Mirza, maybe if I can start with you. First of all, just very interested in your reflections on those poll results. But also, Aviva Investors has been doing a lot on the policy engagement. And as you can see from those poll results, there is interest there from others to get engaged. And just wondering if you can share any reflections from experience at Aviva Investors. How best to go about that? Where would you start?
Well, first of all, I'm a really sore loser. I'm just still.
It's good practice.
Yeah. No, in all seriousness, I can take my debating hat off now. I think the urgency of the issue means that we have to use every single lever. That's corporate engagement, that's sovereign engagement, and that's everything in between. We have invested a lot of time in what we call macro stewardship. It does take a lot of time to build relationships and really understand what works and what doesn't work. And you can't just take parallels with what's happened on the engagement side with corporates, because the dynamic, the leverage, the influence is very different. What I would say is that's what the PRI are for. And we've been really strong supporters of the collaborative sovereign initiative that the PRI has been running for a couple of years. One of the key things with sovereign engagement and corporate engagement, it's not about the volume, it's about the effectiveness. And one of the things that really the PRI have brought is making sure that the engagement agenda is underpinned by really high quality research, so that we go to policymakers with a very clear understanding of their policy environment, the specific challenges that they face. You have to build productive and constructive relationships with key stakeholders outside of the Treasury. And most importantly, our policy recommendations need to be practical and actionable. And the counterparties need to see the benefit and the value add of being part of that dialogue. So if anyone is not familiar with the PRI program, please look into it, support it, get involved however you can. And I can confirm that there's no money exchanged hands for that plug.
Thank you very much, Mirza. Nazmeera, maybe if I can turn to you, and just thinking 91 is involved in a lot of collaborative engagement, including through Climate Action 100+. I know you have a strong focus on emerging markets, and just interested in your reflections from everything that you've heard in this debate. So on both sides, on the policy and on the corporates, what's your takeaways from that, from thinking about investing in emerging markets, and in particular around engaging with state-owned enterprises?
So I think when we move beyond the debates, we have to acknowledge that it takes both. It takes both the sovereign and the corporate engagement, particularly when you think about emerging markets. So if we look at most middle-income markets beyond India and China, the concentration of emissions is immense. So in most countries beyond the two largest, somewhere around 10 companies account for 50% to two-thirds of emissions. In South Africa, 2 companies account for 60% of emissions.
Right.
So as we think about that engagement, there is a need to engage the ecosystem. And I would go beyond just sovereign engagement. It's the banks that finance into the space. It's some of the other interested stakeholder groups, the unions at times, have to be part of the discussion. So it's focused engagement where you can move the needle. If you're going to engage a state-owned enterprise, government policy is, by definition, part of the mix. And I think one of the things we have spent time on is finding policymakers that are likely to be sympathetic to our concerns and figuring out how we can amplify their voices. Because it's much easier to support change from within the system than to be this outside protester who is working from outside, because that doesn't tend, well, our experience is that hasn't been so useful. The last point I'd make is combining different teams, equity team, debt teams, sovereign debt teams, is very powerful. And for example, what you're seeing in the sovereign space is this increased move to sustainability-linked bonds. And what's really powerful about that is in order for them to be issued, the finance ministry needs to bring the whole of cabinet along to the KPIs that are being set. So we've seen, the first that we saw from Chile and Uruguay, and both of them had climate-related targets built in, and that required the whole of cabinet to buy in both cases, which is very powerful.
Great, thank you, and very much that whole of government approach that's required there. So, Jake, if I can turn to you. Now, you mentioned during the debate your role within the Net Zero Asset Owners Alliance. And I was just wondering again, if thinking about what you've heard this afternoon, what's your expectations as asset owners in terms of what asset managers should be doing in this space?
Yeah, we issued a call to action as the Net Zero Asset Owner Alliance back in February that we sought to have distributed to our asset managers independently by each of the members as they saw fit. And it really talked about this idea of systemic risk and set forth some of the different best practices that we've developed that are designed to embed into selection, appointment, and monitoring processes, specifically focusing on some of these systemic stewardship questions. So far we've developed a set of best practices for proxy voting on net zero, engagement on net zero, and then the last one most relevant to this conversation is policy alignment. And how managers are thinking about policy alignment within their portfolios. I encourage folks to check that out, and I'll speak a bit more about it at the Asset Owner Breakfast tomorrow. But I think an important aspect of that focus for the Net Zero Asset Owner Alliance is really trying to figure out ultimately where we as financial actors are able to exert the most influence is often, if you're thinking about it as a market-based system, where do we have the most direct buy-sell decision? And for asset owners, that's really with our managers. It's not with corporations. For most of us, if you're working directly with asset managers, doing it in-house, it might be different. But for most of us to work with external managers, we're one step removed. So that underlying portfolio company might not really care if I sell them or not, as Wespath. But the asset managers we work with, where we have a stronger relationship, we're in touch more consistently, and we have more opportunity to build an understanding and a longer term strategic partnership, there's obviously more at stake for them in terms of really working with us to make sure that they're aligning with our interests. So that's where a lot of our focus has been as the Net Zero Asset Owner Alliance.
Great, thank you, Jake. Anne, fine, if I can turn to you. And again, so I'm going back to the debate, but just your reflections as a US headquartered asset management in terms of thinking about some of the political headwinds that have been seen in the US. What's your reflection from this debate in terms of the role for engagement and stewardship?
No, thanks very much. I'm sorry, back to the boring old fiduciary duty. Prudence, remember loyalty. What does loyalty mean? It means you're investing other people's money, and your duty to them is primary. So unless you can square off what you're doing with your fiduciary duty to generate repeatable risk-adjusted returns, it is for consideration, for dialogue, for debate, but it doesn't and never can and never should step in between you and the people who the money belongs to. So I really like a very important point that Kirsty Jenkinson made on the opening session, which is that asset owners need to have absolute clarity about what they expect from their managers. And really this question of the cascade, the chain of command from the people who the money belongs to, asset owners, if it's an institutional arrangement like a pension fund, or individuals using an advisor for a 401k, the accountability of the manager is now under scrutiny. And therefore, making sure we have the data, the evidence, the accountability mechanisms in place is absolutely vitally important. So we've got to be able to, and this is, I think, finance has its emotional moments. You mentioned animal spirits. I'm not sure that was ever a good idea. Anyone seeing their dogs charging around in the garden says, yes, animal spirits, but it's not the way to run a global economy. So we need something a little more sober and considered. But this issue of investor governance is tremendously important to the next stage. The other thing I want to mention, and I think Nazmeera touched on it very well, is that the concept of the just transition is what the preamble to the Paris Agreement is all about. If you go back and read that, that's also what we've all signed up for. Making sure vulnerable communities, the impact on the workforce, indigenous peoples, this needs to be part of the plan. And therefore, rather than even just thinking about financial markets, where's the money? We know it's in the private financial markets. And policymakers, we've got another group, which is civil society, and their representatives and stakeholders. So we've got to get into collaborative design mode, where all sides are able to build this from the bottom up. And we've done it before. I do not believe in the idea of the field of dreams. That's a bit where we are at the moment. If we build it, they will come. So said Kevin Costner. I don't believe it, because we don't know where the field is. We don't know what game's going to be played, or even if we've got our socks and shoes on and we're ready to go. And it seemed to be in the middle of the night, if I remember, that baseball game, they're building it. So the point is, we've actually got to design these investment opportunities to meet the investment needs, the fiduciary needs of those who have the money. And the point is, we've done it before. I was speaking with someone just the other day about the Novo Mercado. This was my first piece of work, working with the regulators, the stock exchange, the trade unions, the companies, and others in Brazil to build out a new market, which is now hundreds of billions of dollars. It's, coming on the wake of a complete dearth of investment in Brazil. And now, these issuances are majority taken up by international investors. The way we designed it was through having conversations with investors about what would bring them in. We're seeing this explosion up to $1 trillion in the fixed income markets, green, rainbow, pink, multicolored bonds, but use of proceeds bonds. And we're now getting our act together, I think, on standards and data and comparability. These are significant sums of money. So I'm quite confident the money's there. What's lacking is an understanding of what investors actually need. So let's design for the idea that the customer is always right. And the customer the working people, the families, the communities whose money that we're investing, and they have a long-term perspective, and they have multifaceted interests in making sure that we have shared prosperity and an inclusive society and a safe, natural environment to live in.
Great, thank you very much, Anne. We are now out of time, so look, just a very quick wrap up. I think the three big messages coming out of the debate and this discussion: urgency of action. Time is ticking too quickly now. We really need to be accelerating the net zero transition, and stewardship, so engagement, has an absolutely critical role to play on that. Second part, I think good conclusion that absolutely corporate engagement is key, but there is a role on policy engagement as well if we are going to manage down those risks. I think we've actually heard from all four of our panelists that you need that combination of the two working together in terms of what the policy side is doing and that corporate engagement. And third, collaboration. It's a really effective, a really efficient way of doing this. And given that we don't have a huge amount of time, effectiveness and efficiency is very much a good thing. So whether on the corporate side, looking at Climate Action 100+, or Climate Engagement Canada, and then, thank you, as Mirza was saying before, on the policy side, on collaborative sovereign engagement initiatives, there are opportunities to get involved, to work with your peers in this space. So on that, I'd like to say a huge thank you for my panelists for their fantastic contributions, and we'll hand back to Amber, I believe.
Right.
Thank you.
Thank you.